Welcome back. This is Module 8A, Venture or Risk Capital. In this module, we're going to take a look at venture funding, business angels, who are very important to small startup companies. There are some other sources of investment capital, and again, here we're talking about equity funding, not loans, not going to the bank. We're talking about people who are going to invest, meaning want to give you money, typically in return for a piece or a percentage of the company. You will take a look at how you would actually evaluate an offer if somebody wanted to buy into your business. And lastly, we're going to take a look at the business valuation process. How does a potential investor or venture capital firm decide whether or not your business is worth investing in, whether it's a good business or not? You've seen this slide before in the legal piece, and again, what I want to do is to reemphasize that the idea of a corporation or a limited liability company gives you some protection, but it's basically aimed at the stockholders. It is not aimed at, that protection is not aimed at the officers or active managers who do have liability despite the fact that they're organized as a corporation or LLC. And of course, as a practical matter, most banks, most landlords, utility companies want a personal guarantee. They're not just going to take the corporation's credit as good enough for the business. They're going to want you to put up your house, your bank account, your personal assets. And of course, that strips you of the liability protection. For the, again, just as a review, as far as negligence or wrongdoing or something like that, you can possibly get insurance. In some businesses, it may be very, very difficult. Depends very much on the industry. There are a number of stages. The textbook at, I believe it's page 349, table 12.1, talks about gives the definition of the stages of venture funding. Very tough as a brand new startup to get venture capital or what's called seed capital. Usually you have to get a loan. All right, no way around it. Very, very hard to get somebody, some venture capitalist, be they a large or small VC firm, to take a look at you when you're just starting up because you don't have a track record. On the other hand, after you've got about 3 years, typically 2 or 3 years of good business behind you, some steady growth, a track record, then it's easier. So if you're looking to expand, so typically a new venture will start out small, and then once they're established, then they will go on a major expansion when they can get access to venture capital. Now, if you're doing innovation within a large corporation as an intrapreneur, as we discussed earlier in the course, maybe this big corporate conglomerate that you work for, that you're a piece of, can fund it. But again, they're going to look at your new product line, your new offering through the same eyes that a venture capital firm would, and say, hey, is this the best use of our money? So, great many parallels, even though theoretically, if you're part of a big firm, yeah, it's a little bit easier to get money. Not always true. Of course, one way to get additional funds, is to be acquired by somebody or to buy somebody else, or do a what's known as a leveraged buyout. And we'll look at that in class 11. For the average small business, new startup, there's this informal venture capital market called business angels. And as the chart says, they are looking for investment opportunities. They tend to focus on a given area. Now, the text points out that they prefer manufacturing. Not necessarily true. All right, more recently, there have been many service and technology type firms that have gotten funds through business angels. There are different ways of finding them. Basically through contacts. What kind of contacts? Well, if you look at the reading for this class, you'll see a number of things. First off, in the read for this week, which was posted last week, there says read for venture capital. There's an article about AceNet through the Small Business Administration. This is a web-based network giving locations and contact points for various kinds of business angel organizations. You're going to have to rotate it. I was unable to rotate the pages properly and make them look good, but you can take a look at it on your screen. The second article in the group is called the Business Angels 8 Wings. This is a business angels capital firm that focuses on women-owned businesses. Again, they have their own niches and look to support things that they believe are important, industries that are important, groups that are important, and those kinds of things. There's some articles on the survival plan, and we'll cover that a little bit later. One of the things that you should look at is the business incubator. When I talked about mentors and having a network, a support network to help you, one of the things was incubators like the one at NJIT, the Enterprise Development Center. The small business development centers at the county colleges can point you to local business angels that may be available. A small business development center at Rutgers is another one that is very, very good. So these are out there. There's another supplemental reading called Good News in Newark, and it's actually, the file name is Harvest Good News, and it's about the Greater Newark Business Development Consortium. And this is an organization a nonprofit organization that makes either microloans or can point you to people that can provide funding, venture capital funding. There are also other sources of funds out there, investment funds, again, not loans, investment funds. You can do a research and development limited partnership. The text talks about this at page 332. General partners are looking for R&D, money, and some wealthy investors may be looking for tax shelters. High risk. It's a nice idea, but it's not many of them succeed. I kind of give the analogy that it's similar to the oil drilling rights and that kind of thing. These investment companies where you buy a piece of an oil drilling exploration process, and it's kind of like rolling the dice to see if you're going to win. There is a variant that we'll talk about a little later in the course, but I'll mention it now. Sometimes strategic alliances are good. The biotech companies that, and I may have mentioned this earlier, but for example, a biotech company has a need for terrific research capabilities, for state-of-the-art labs. And maybe the big drug companies have the labs, but they don't necessarily have the creative spark, the talent, the special people that are needed. So they put together some sort of alliance or joint venture. And we'll really talk more about that under expansion. Come back and revisit that. Another idea is something called Small Business Innovation Research, SBIR, grants. This is discussed in the text at page 334. They are grants from the federal government in areas of health, defense, even education, to look at new areas. And these are grants. These are not loans. So there is grant money out there. I suggest that you look at a website called grants.gov, grants.gov, G-O-V. Grants.gov can point you to lots and lots of places to get federal governments, different agencies that have money available. Lastly, or not lastly, but another form is grants from the states. New Jersey is what I'm familiar with, obviously. And if you go to the state of New Jersey, www.state.nj.us, which is the state of New Jersey website, NJBiz, B-I-Z, NJBIZ, and click on incentives and resources, you can find places, different kinds of grants that are available. And basically, the idea behind many of the state grants is that it's an incentive. They will give you money provided you can convince them that you will create jobs within the state of New Jersey. All right, particularly middle-range jobs, blue-collar jobs that are needed, to keep the economic growth, to keep the economy going. But again, things like manufacturing, service industries, things like that. All right. I mentioned that there were stages in the venture capital funding, but there are also stages in the decision process. Do a preliminary screening, need a good business plan. You submit your business plan to these people. They want to read it. With good financials, clear mission and objectives, a clear executive summary, has to really tie together. The financials have to make sense because they're going to look at them carefully, because typically these people who are going to invest are money-oriented people, so the one thing they do understand is money and balance sheets and profit and loss statements and that kind of stuff. Assuming that you pass that, you agree on the main terms, how much money over what period of time, what piece of the business you're going to give them in return, and how much control, if any. And typically they do want some control, because if they're putting up, particularly if they're putting up a lot of money. The due diligence review is typically done by the venture capital people's lawyers and accountants. They send an accounting team and a legal team in to look through every aspect of your business, your books, behind the books, talk to people, really find out if you're telling the truth, how accurate your stuff is. This can take anywhere from 1 month to 3 months. Typically it's in that range. Again, the more money they're putting up, the more complicated your business, probably leans towards the 3-month processing. And finally, you put together an investment memorandum that gives all the details, specifies, and that's not an easy job. Again, that's typically done by accountants and attorneys, and specifies all the details of the deal. Well, there are some problems that occur. Again, I will point you back to the reading for this week, back to the article that talks about the venture capitalist 5-point surveillance plan. It's a little bit old. It's a dated article. It's back from 2001, and that was basically when things were slowing down. Of course, they have slowed down almost to a crawl now. But the point is that the venture capitalists are much more conservative than they were, say, prior to the year 2000, back in the 1990s. They want a little more control over the purse strings. They want to make sure you know where the money is going. Another article that's there, again, portion of it is sideways. You're going to have to turn it around, but I'm sure you can do that. Is an example of financing a startup business. And if you look at that article, and even if you do nothing else than read the chart that's at the beginning of the headline, it ain't easy, is what it amounts to. Lots of ups and downs, trying to make things happen, failures, things didn't work out. Bank drops out, too much time elapses, one of the key backers passes away, problems. But if you persevere, if you hang in there, it can happen. It certainly can happen. Well, as this chart says, the mistakes in going after, that companies make, the ones that don't get the funding, why not? Well, frequently, you are the inventor, or you put on the hat of the inventor as opposed to the entrepreneur or marketing person, and you are enamored with the technology or the science that's involved, and you're pitching technology instead of benefits. You're selling features, not benefits. We talked about that in an earlier module. You're not telling them how you're going to make money. You don't look at marketing. I know many companies that have a great product or a great service offering, and I sit down and talk to them. I say, well, what's your marketing plan? How do you go about selling it? And you get this silence. They say, well, referrals. One customer suggests somebody to call us because we've got this and they might be interested. Yeah, you can do that. It's a slow way to grow a business. You got to try and get your message out there faster. And the business plan. One of the reasons why this course requires a business plan as a deliverable to pass the course is that the business plan is key to making things happen. If it's incomplete, if it doesn't make sense, if the numbers don't balance, they'll just put it on the side and never even look at it. Again, I mentioned the executive summary. It has to capture the attention of the reader and make them want to read the rest of the plan. Maybe, again, it's too complicated. Maybe it's poorly written. If you do not have a good mastery of the English language, assuming that you're doing your business plan for an English-speaking audience, have somebody proofread it. Have somebody, edit it, who uses, proper language, proper sentence structure, so that it's easy to understand. Nothing wrong with that. Well, let's look at reality. What's the odds of making this thing happen, of getting the money? There are lots of proposals out there every year. Maybe 10% get read. The other 90%, they look at the executive summary, say, doesn't sound interesting, sounds, stupid, sounds too much like something else, not innovative, better places to go. $10 to $20 are go through the due diligence process and that whole thing that we talked about, the various stages, and probably half a dozen get some money. Sounds like bad odds, but out of a given venture capitalist, maybe there's more money out there. Again, business angels may help, but here's the key. The person was selling science, was selling features, was selling the invention, not the business plan on how to capitalize on that, how to make money on it, how to be profitable on that. In other words, that person had the inventor hat on and not the entrepreneur. All right, let's take a look and see if you say you found a business angel or a rich relative or friend or somebody like that who might be interested in your business. What do we do? Okay, let's take a simple example. You are the entrepreneur, you're the only owner, you look for 100 grand. Investor has 100 grand, wants a piece of the business. Key question. How much of the business should he get for the $100,000? 10%? 20%? 50%? If you give up 50%, you've lost control of your company. You have joint control with somebody else. If you give up 51%, then you're really in trouble. But so let's say, maybe it's a smaller piece, but how much? And don't forget that the profits are distributed based upon percentage ownership. So if this investor gets 30% of your ownership of your company, he or she is entitled to 30% of the profits of the business. So again, it's a very serious decision as to what kind of percentage you give the person. Well, let's assume you have a bricks and mortar business. Your balance sheet, right? Assets minus liabilities equals owner's equity. Okay? And the owner's equity is $300,000. If they bring in an extra $100,000 in assets, if this guy gives you a check for $100,000 and you put it in the bank, that extra $100K would be 25% of the new business. So, sounds like 25% would be a good percentage of the stock to give to the investor. But what if it's not that simple? Where you don't have many assets. Or maybe your assets are intangible. A patent, a license, some sort of technology, and it's not easy to put a number on it. Well, then what you want to do is do a due diligence review of the business plan to figure out what the expected net profit is. And probably the investor will do that due diligence review. How much profit do you really think we're going to get? Now let's assume that the investor can get 4% return on equity from his bank, by putting it into a certificate of deposit. And these percentages are going to vary from moment to moment in time, depending upon the economy. Or he can put it in a mutual fund, that $100,000 in a mutual fund, and pretty much expect to get 8% return per year. Of course, mutual funds go up and down, so there's some risk, and of course, the more risk, the higher the return you want. So that's why, with a bank, it's safe, it's secure, it's guaranteed 4%, but it's only 4%. If you're willing to take risk, say with a mutual fund, you look for a higher return. Well, if the profits from your business look pretty certain, the investor may want 10%, in other words, $10,000 a year return profit on his 100K. If the profits look shaky, maybe he says, well, I may make nothing, therefore I'm going to set my objective, my goal at 15% to make up for that risk. 15% of $100,000, $15,000 a year. Well, if the company's expected net profit is $45,000 for the year from operations, the investor may want 22% of the business, which would generate the $10,000 he's looking for. Or if it's risky, he may say, hey, I want $15,000 a year in profits. That's my objective, that's my goal. So they would want a third of the company. Now, what do you settle on? That's a matter of negotiation. And we'll talk more about that as the course goes on. Under managing the business. But again, that's probably going to be the range where you are. If you offer that investor 5% of the company for his $100,000, they'll probably laugh in your face if they know what they're doing. So again, just trying to set the parameters here. When somebody invests in your company, they have to come up with a valuation of your business, this due diligence review. Valuation is important. And it's pretty much a black art. There are people out there who make a living doing business valuations of certain industries. They're experts that specialize in all different kinds of industries. And for a fairly significant piece of money, you can go out and get a valuation of the business. Typically, the credentials of these people are CPAs or things like that. But again, it's somewhat of a black art, so not easily defined. Lots and lots of variables that are not well defined. If there are publicly held companies that are similar to yours, hey, that's the easy way, because a publicly held company, the value of it is the stock price times the number of shares of stock that's out there. And there are some, it's good gauge. However, if there aren't any publicly held companies, and frequently in small startups, you wouldn't find one that's similar. You can use replacement value, but here again, replacement value talks more about bricks and mortar and equipment. It doesn't really look into intangible assets and the value of your trade name or brand name, the value of intangibles like copyrights and patents. Kind of tough. Adjusted book value is almost worthless. Yeah, it talks about acquisition costs and that, but it doesn't say whether the things are still of the same value they were when they were bought, have they increased or decreased. Bottom line, most widely used is the earnings. You take the earnings that you expect to have, that $45,000 that I just talked about on the last slide, $45,000 a year, and you look at the industry price to earnings ratio, and that is some multiple. So if the multiple is 10, just to keep the arithmetic easy, the price to earning ratio is 10, then if your profit is 45,000, then the valuation or price of the company would be 450,000, 10 times the earnings. Again, a black art varies very much by industry. One of the things they do look at, or investors, investment firms look at, are ratios, and they're just ways of gathering numbers to compare one company to another, to compare your company to the industry average, to see whether you're doing better or worse. There are basically two kinds: liquidity or solvency ratios. It's another term that's used. It says basically, can we pay our bills? Do we have enough money to keep business running? Activity ratios, on the other hand, look at how good are we at managing what we've got. How good is our management team? Our processes? We're going to look at each of these. In the solvency or liquidity ratios, here's a definition of working capital. It's your current assets. And current assets, if you remember from the finance class, current assets are things that are cash or readily convertible to cash. Things like accounts receivable, inventory, cash, obviously, short-term notes that people owe you, things that you could, again, easily convert. Current liabilities is money that you owe now or soon, as opposed to a 30-year mortgage, where the next 28 years payments aren't due for a long time. So we're looking at stuff that is current. The current ratio or working capital ratio is the current assets divided by current liabilities. And as it says, if it's greater than 2, it's great. Unfortunately, if you have twice as much current assets as you have current liabilities, you probably don't need a whole lot of short-term credit, but it's easy to get. It's the guys who don't have the money that need the credit, and that's a little tougher to get. The acid test or quick ratio pulls the inventory out. Why would you pull inventory out? Well, particularly finished goods inventory. What's it really worth? Laptop computers. The laptop has got a list price on it of $1,100. Is it really worth $1,100? If it's a model that's, say, 6 or 12 months old, still sitting in the warehouse, it's probably useful as a doorstop and not much more. So, inventory, particularly finished goods inventory, can be misleading. So they pull that out to find out, what do you really got that's worth money. Activity ratios. There are a couple that we look at. The average collection or number of days sales outstanding is, you take your accounts receivable and divide it by your average daily sales. That tells you how long does it take to collect your money. Are people paying you quickly, or do you have to chase them for 2 or 3 months? before you get paid. Obviously, that number should be as small as possible. Inventory turns. We talked about this in an earlier class. Remember the rocking chairs versus the supermarket example of how many we sell one rocking chair, take the $100, buy another rocking chair, sell it, put that profit in our pocket, go back and reinvest in another chair. The more you sell and the less inventory you have, the better. The more you turn your inventory, cost of goods sold, the amount of stuff sold, over the value of the inventory at any point in time, gives you the number of turns. You want to have as many turns as possible. Another thing is called leverage ratios. To look at capital structure, take a look at page 367 of the text. Debt to equity and profitability ratios. There are several kinds of profit ratios. They talked a little bit about on page 368 of the text. But what is typically called ROI, or return on investment, is really either return on assets or return on equity. Return on assets is defined as net profit over the total assets. It's good for an operating manager. It enables the company to measure how well the company's operations management is really using its assets and generating money. The other way of looking at it is return on equity, and that's a little different. And it really looks at the investor's standpoint or the owner's standpoint as to what they're making. Example, and see if you can follow me on the numbers here. Let's assume that we have a revenue of $7. Could be 7,000, 700,000, 7 million, whatever you want it to be, but $7. Expenses of $4. Therefore, we got a profit of $3. Our balance sheet, that was income and expense. Our balance sheet, we have assets of 10, no liabilities. So therefore, we have owner's equity or capital of 10, right? Assets minus liabilities equals equity. So 10 minus 0 equals 10. Okay, let's figure out these two ratios. The return on assets is the profit, 3, over the assets, which are 10, or 30%. Return on equity, profit, 3, over equity, 10, again, 30%. Okay, no big deal. But let's change it. Now let's say that we go borrow some money. Instead of the owner putting up the $10, he only puts up 5 and he borrows 5. Again, we've got the revenue of 7, expenses of 4. Let's toss in some interest expense of 1. So now we've got total expenses of 5 against a revenue of 7, which gives us a profit of 2. Our balance sheet, the assets are still 10. We have a loan out there, which is a liability, so that's 5. Therefore, our equity, 10 minus the loan of 5, is 5. Okay, so now we have a profit of 2, assets of 10, equity of 5. Now let's look at these ratios. Return on assets is 2 over 10, or 20%. But return on equity is what? profit is 2, equity is only 5. So it's 2 over 5, or 40%. Our return on assets is 20%. Our return on equity is 40%. We are leveraging our results using debt. We are making money using other people's money. That's great. That works. However, you have to be careful. It works provided that you can make a higher rate of profit than the interest rate that you're paying. If the interest rate on your line of credit goes up and your profits go down, then you're in trouble because you're losing money. But as long as you can make a higher profit margin, 10%, and pay interest on that loan of, say, 6%, the other 4% goes in your pocket, or at least into your business. Okay, that's where we are for this module. In the next one, we're going to look at launching the new venture. Should you be a first mover or a follower? What are your duties, personal duties, as a leader of the company? We'll take a look at a pricing example. How do we apply some of this stuff that we just looked at, that have looked at over the last few classes? Talk a little bit about private branding, how it contrasts with outsourcing. Make sure you keep up with the supplemental readings. And the next module covers chapter 13 of the text. Okay, thank you.